Hello, the company being analyzed today is Basilic Fly Studio. This is a VFX studio, so it makes the VFX for films and commercials and all of that. A very interesting company, very interesting industry. Today, we're going to analyze the company's financials, how efficient it is, its future plans for expansions, what are its revenue guidance for fiscal year 2026 that it stated in its con call, and let's start. So first we have the market cap, 932 crore company. Hmm. So pretty small cap company. Current price of one share is 369 rupees. Book value per share, you can see 87 rupees. Pretty high return on equity, 24.8%. Return on capital employed, 31.2%. Pretty nice. Price to earnings ratio of 23.1. If you want to take a look at the price of the company, it seems that the company recently had its IPO, very recently. So the earliest you can see is September 23. Okay, September or 2023, the price goes to there. So it recently had its IPO, and after IPO, seems that the price has kind of remained the same, actually. Risen a bit, but kind of remained the same. Now, enough about the price. Let's take a look at the financials. So we are at the annual report, and first thing first, revenue massive growth. 129% CAGR is massive. 25 crores in fiscal year 2022, 2023, 70 crores and 102 crores, and finally fiscal year 2025, 304 crores. Majority, a massive amount of this massive growth you saw, this three times growth came from acquisition of another company. So they acquired one of us, a UK based VFX studio. So yeah, they're expanding the UK global company, truly. So extremely high. Even before that, extremely high revenue growth. It was growing very well. And 300 crores, big, big, big. EBITDA. EBITDA has grown a lot too. 229.58% CAGR is massive. Of course, the base was extremely low, only 1.75 crores in fiscal year 2022, now all the way to 62.65 crores in fiscal year 2025. Then we have net profits. Net profits growing by 245.05%. Massive, massive growth. Again, small base, but now 45.6 crore rupees in fiscal year 2025. All right. So 300 crores revenue, 62 crores EBITDA, and 49 crores worth of net profit after tax for this company. Let's take a look. Okay, we got return on capital employed declining, declining return on capital employed, and it's been declining because the company's asset base has, of course, also been rising a lot. They recently acquired the UK consolidation, so UK subsidiary, declining return on capital employed, but they will try to actually maintain it. Sorry, that's return on equity. But still, same thing. Return on equity, return on capital employed, both are seeing a decline, still better than their fiscal year 2022 for return on equity. Return on capital employed has become really lower, but it's still a good number and they will try to maintain it, I guess. Then earnings per share, and we have seen book value. So earnings per share have grown from 10.94 rupees to 16.11 rupees. So this has not been really big. You can see profit after tax rose so much, EBITDA rose so much, but earnings per share, because I believe a lot of dilution must have taken place. They must have issued a lot of new shares and all that during this period. And you can see, they also had the IPO. The IPO, yes, the IPO must have caused a lot of dilution. So all of that, then book value per share has grown 39.4 rupees. I think this massive decrease, book value per share, again, IPO happened. So number of shares increased massively. But then over the few years, we have seen a big rise. Okay, still solid return capital employed, return equity numbers, but a bit on the decline. Again, you can see here, I don't know if you can see this. Yeah, impact of UK ops consolidation. So the UK studio they acquired, it will be very important for costs, very important for international expansion. But again, it is in the UK, so the costs are very high. Costs are very high, so return on capital employed will be lower. Then debt to equity. Okay, okay. Did reach a low of 0.02. Lower the debt to equity, way better. 0.25, all right. All right. At least it's lower than a fiscal year 2022. Debt to equity 1.05. Hmm. Headcount also increased massively. Again, they acquired the UK one of us of visual effect studio. So that increased the headcount. A lot of employees came from that. And not exactly the most operating cash flow. We can see operating cash flow wise, it is a positive company, but free cash flow, you can search this term up. Free cash flow may be the most important or one of the most important metrics in financial evaluation of companies. Free cash flow wise, not really that positive, not really that big. Okay, so we looked at the financials. At least operating cash flows are good. They're positive. Mostly they're positive. I think dilution must have taken place. That's why you see earnings per share not increasing. That can be negative. Dilution is happening. So, as shareholders who have owned, let's say, since 2023, if dilution occurred even further, it will obviously harm the existing shareholders. Dilution always does that. Let's see what the company is actually doing. So, you can see already, already, India based Basilic started 2013. March 25 workforce 450. This increase, we already saw that. This is see, this is alone. This is standalone. So you see, India-based Basilic started March 2025 workforce 450. Then the London-based studio that they acquired, one of us, it has 350 workers. So together, 700 something workers became one entity. 390 plus clients, 11,300 plus projects they have worked on. Okay. 8,100 plus commercials, 2,100 plus web series, 1,100 plus movies, and massive, massive movies, massive, massive studios, Netflix, Sony, all of them. All right. So let's just go into it. Um, where is this page? Yes. Let's continue. So, Basilic Fly Studio, it's a global company, okay? You can see the corporate structure. It's a global company. Global presence, you can see in London, France, Canada, Chennai, and Pune. And it's important. See, the Indian branches, like Canada, sorry, the Chennai and the Pune, the Indian branches, they're obviously lower costs. So the London, France, and Canada studios, the branches there can actually outsource some of the work to the Indian staff to reduce costs, cost optimization, while they can conduct the high value, high cost VFX effects. So all of these branches can work in sync with each other for further costs optimization. All right. And cost arbitrage, of course, the Indian workforce will obviously have lower costs. So that works very well too. They can make a lot of money, a lot of EBITDA margins will be coming from the Indian studios. So international studios will be lesser profit margins. Then trusted by the world's most, sorry, trusted by the world's leading studios and streamers. You can see Netflix, Sony Movies, Paramount, Prime Video, Disney. They have worked for all of these. See, Sonic 3, oh my God, they actually work for Sonic 3. Amazing. Who else? We got Doctor Who, we got the Captain America movie, we got Rings of Power, Masterclass, Mission Impossible, the last movie, Thunderbolts, a lot of commercials. Which movie is that? I don't know. Sinners. Oh, but they work for Sinners. So a lot of major IPs they have worked for. Now let's take a look at the outlook. What is the outlook for the industry they're working in? We saw they're a global company. So the global VFX industry. So global VFX industry. I think I should zoom this in. It may not be the most clear. In 2021 was worth $26.3 billion. By 2028, it's expected to reach $48.9 billion. So from 2021 to 2028, expected to grow at a CAGR of 10.9%. And it's a global company, so global VFX industry. All right. but France and UK are the main things. Then India, yes, India. Now the Indian VFX industry had a 9.4% revenue dip in 2024 due to global headwinds. Global headwinds, right here. Global demand slowdown. There was a Hollywood writers' strike. So the Indian VFX industry, of course, relies on a lot of foreign movies. They work on a lot of foreign movies. So foreign movies demand went down because of stuff like this, Hollywood strikes, domestic broadcasters focusing on fewer, higher quality productions, and all of that. So global demand dipped and revenue dipped overall. All right, but is poised for a strong recovery with a 13% CAGR. It's expected 13% CAGR all the way through 2027. So global industry 10% and 2027 13% CAGR for the industry as a whole. Maybe Basilic will grow way faster than industry as it has shown in the past. Here you can see it's expected to reach 147 billion rupees, the total industry, whereas VFX, this is 2024. So this one is 2024, this bar, and it saw it actually dipped. See, it dipped a little. Here you can see animation, all of these, it dipped a little, all in billions of rupees. It dipped a little because of global headwinds in demand. Then let's move on. Important info to be given. Spoilers, yes. And we already saw this, already saw return on equity, we already saw return on capital employed, we saw the book value, we saw the earnings per share, so old stuff. Fixed asset turnover ratio, revenue over the assets. Higher this number, the better. 17 is still really good, but okay, a bit of a decline. But again, they acquired the UK subsidiary, so maybe this will improve in the future. Interest coverage ratio. Though we have seen a dip all the way to how much is this? 13.93. It is really healthy. Interest coverage ratio of 13.93. This is operating profit, EBITDA upon interest have to pay on the loans. 13.9 is extremely healthy. So I think nothing to worry about in terms of debt. Current ratio, 3.78. So current assets are 3.78 times current liabilities. I guess that's pretty good. Already saw debt to equity, 0.25. Then standalone. So I believe this will be the India business. So the India business, a lot of client concentration. So top five clients contributed to 60% of revenues in fiscal year 2025, and other clients, all else, contributed 39.3% of revenue. Okay, so a lot of client concentration. Oh, sorry. Yeah, this is becoming sloppy. Uh, this is in crores. This is a contribution by crores, in order of crores. This is only the India business. So top five customers contributed, let's say in crore rupees, all the way here in crores, you can see crores, 44 crore rupees for the India business, and all the other clients contributed only 28 crores. Oh my God. Uh, hmm. Okay, so a lot of client concentration in the India business. Then for the India business, where are they getting their money from? Fiscal year 2025, let's see. So the light blue, you can see light blue is Europe. So 45% of revenue came from Europe. Interesting. North America, 44% revenue came from North America, 8% came from other countries, and 2%, very small, 2% came from Australia and New Zealand. So North American dependent and Europe dependent. Europe is pretty big though. So yeah, Europe could mean the entire continent or some European countries concentrated. Anyways, let's take a look at the balance sheet. Pretty healthy balance sheet, by the way. The company has a pretty healthy balance sheet. Here, I think we can pay attention to a few things. These are all in crores of rupees, by the way. Let me even make this further. So, 179 crores worth of reserves and surpluses, shareholders' funds. This includes retained earnings, reserves, and surpluses. Basically, the money left after to the shareholders, basically 202 crores. Current liabilities total 54 crores only. Okay. And current assets not current assets. So current liabilities we saw, see here, current liabilities 54 crores, cash and cash balances, cash and bank balances of 42 crores. Pretty nice. So balance sheet seems to have cash. They seem to have 42 crores worth of cash, and a lot of reserves and surpluses. That is always a good thing. A lot of reserves and surpluses is nice. Finally, finally, let's talk about the UK and the French market because they have some of their offices, some of their studios there. Okay. So in France, there's a tax rebate incentives are there for VFX and film production, which will encourage more films. And if there's more film being made, more VFX and more revenue for the company. Okay. So in France, there's a tax rebate amount. Let me zoom in, let me zoom in. 30% of qualifying expenditures incurred in France. Tax rebate up to 30% of all the qualifying expenditures incurred in France. Up to 40%. This tax rebate can be up to 40% of total costs if French VFX expenses in France exceed 2 million euros, 2 million rupees, $2 million. I suppose euros. I suppose euros. But 40% tax rebate. And of course, Basilic does have a studio in Paris, branch in Paris. So yes. Then VFX related 10% bonus. Okay. A 40% tax rebate applies to projects with more than 2 million euros in VFX related French expenses. So expenses in France, I guess, more than 2 million euros. And more than 50% of the French spending is VFX or post production expenditures. I believe they're saying in movies. Usually, 50% of the French spending is in VFX and post production expenditures. And again, you can see all these rebates. You can read these rebates. So this will boost, or they're trying to boost films in France. France is a big thing. Then we have UK. UK, again, they acquired One of Us studio. Okay, one of us, they paid, I think, a lot of money for them. It's very important to see how is the UK market going to do. One of us will rely on the UK market. And here you can see expansion of studio space. Studio space in the UK has doubled in the last 3 years, with the UK expected to be the second largest film production center globally by next year. UK market, second largest film production center. And you can see a 40% tax relief for independent films. UK films with budgets up to £15 million will now receive a 40% tax relief under the new indie tax credit. Okay, so indie films, this will promote more indie films production. Then we have an increased visual effects relief. The tax credit for visual effects in films and high-end TV has been increased by 5%, bringing the total relief for visual effects up to 39%. So maybe 39% of visual effects costs can now be gone. It will be decreased by tax credits being provided to the filmmakers. So this will encourage more VFX, I guess so. It's trying to encourage that. And the 80% cap on visual effects costs have also been removed. So maybe visual effects costs as a percentage of total costs being 80%. Now that has also been removed. They're really trying to, I guess, encourage VFX studios, which will, of course, benefit Basilic. Then films under the £15 million budget will receive a 53.3% audio visual expenditure credit, translating to a 40% relief. So more reliefs, more credits, more tax rebates being given for the UK market and the French market. Both of these rebates seems to be encouraging VFX and films. Films, but more importantly, VFX. So we analyze the financials. We have analyzed all of that. We see markets are expected to grow at 10% globally and 13% for Indian markets at least. The Indian VFX industry is expected to grow by 13%. Good. Finally, con call. This is by the con call. Very only one thing. Okay, the guidance. We are only going to take a look at the guidance. So there's a question asked by an analyst, and the second paragraph is the CEO. So, hi, question asked. Congrats on a very good set of numbers. What kind of guidance would you like to give for fiscal year 2026 in terms of revenues and profit after tax margins? Okay, so this is Gaurav, person from the management, okay, the company itself. They're saying that, as I mentioned with my remarks, with the current run rate, we're expected to reach the level of 450, 500 crore rupees in terms of top line, and we expect our margins also to increase gradually from the current levels as we do more offshoring. At the high level, we expect the margin to improve within the range of 2 to 3%. Okay, they're expecting 450 to 500 crores this fiscal year 2026, and fiscal year 2025 was 304 crores. So that is around 50% growth rate in revenue. Yeah, uh, 50 to 60% growth rate in revenue. Massive growth they're projecting, and they want their margins improve in the range of 2 to 3%. So they want their EBITDA margins and profit margins to improve by 2 to 3 percentage points. All right, so this is the guidance. Massive growth, a fast growing industry, and of course, they recently acquired. Now, the video would end here. This is all I have. All my notes that I've gathered, it's done. All my notes are gone. Now, if you want, we can do some off script stuff. Okay, we can do some off script stuff. Um, let's see, what can we do? Okay, big production houses like Netflix announced large budget spend $18 billion for running of film running year 2025. UK films and high-end TV spend reached almost $7 billion in 2024, giving the VFX work in 2025. So billions of dollars are being there. And tax incentives are being fueling UK, France, Canada. All that. Canada, yes, they are expanding in Canada also. Basilic. Okay, we're gonna continue this. I like this off-script stuff. What else? What else can we have? Yes. Okay. Significant collection by UK subsidiary. The consolidated cash flow from operations turned out to be positive at 9.6 crores. We saw that against 28 crores negative, primarily due to age debtors only. So they recovered more money. They collected more money from the people, the customers. Okay. A lot of stuff we can read. This is a con call. You can read this. You can go to screener.com and read all of this. I think, what should we do now? Okay. A few things I would like to show that I did not cover. We can see this. Just give me a bit of time. Hold up. Where is it? Where is it? Where is it? Of course, you can always read all this, the technology about tech power transformation. I hope they worked on Avengers Endgame. That would be pretty cool. Um, yes. So, strategic task allocation. Tasks are assigned to India for cost-effective execution, and advanced VFX handled by newly acquired Paris studio for high-end creative output. All right. Then, operational efficiency gains. Lower labor costs in India reduce overall project spending. Simultaneously, multi-location workflows speeds up delivery, and modular scalable infrastructure supports high volume projects. So again, UK market, we have one for us. The Paris market, we have a Paris studio also. We have Indian studios. India, lower cost, more cost effective, and the Paris and the UK studios can handle different stuffs. So they're working in synergies. See, they're working in synergies. Then they have a global vision, smart distribution of tasks to different other studios based on complexity and cost, ensure quality, speed, and optimize spending, and to strengthen Basilic Fly's position as a full spectrum VFX powerhouse. So they want to become a big VFX company, and believe one of their strengths they're trying to say they will now have is that so many different studios in so many different places. Each studio will be able to handle one specific task, more specialization, specific type of tasks, speeding up the entire process. Uh, Sounds good to me. Yeah, I don't know much about this. I think Vision 2026. Vision 2026. Let's read this. They're okay. They're expanding in Canada. They have an AI lab. Oh my God, they have an AI lab in London. domestic market expansion, and they're exploring even new mergers and acquisitions. Interesting. Um, Strengthening global presence by expanding across geographies. They're targeting regional diversification in Europe and North America, and they're expanding the delivery capacity for large scale, high complexity projects. All right. Then, yes, again, India is a lower cost, right? India will lead to more cost savings. More cost savings lead to more profits for the company. They want to capitalize cost arbitrage of expanding in Chennai and Pune, trusted by tier one production houses as Amazon, Netflix, and Sony. I think cost arbitrage meaning again Indian workforce, lesser pay, lower costs. So work that can be if work in the UK and Paris studios, and maybe in the Canadian studios, it will be some of that will be transferred to India. Maybe the IT work, maybe some other work leading to lower costs. So cost optimization. All right, nice, nice, nice. What else can we read? Hold up. Hmm. I guess you can always pause and read all this. Yeah. This is the fiscal year 2025, the EBITDAs, the second half of the year, the first half of the year. Uh-huh. First half, second half of the year. We can read the con call. We can read a few things about the con call. All right. Let's read a bit of the con call in that case. The con call says, moving on to the next point, this is said by the management themselves. We made a significant improvement in DSO, days sales outstanding. How many days does it take for the studio to actually receive money from the customers? Okay, they have given their services on credit. The faster it is, the faster, the lower DSO is, days sales outstanding, the faster they will get by the cash, which is very important for the cash flows. And cash flows are one of the most important, maybe the most important metrics for valuing a company. Now, at the consolidated level, India DSO, so days sales outstanding in India are very high, still high, and may take time for another 2 quarters to reach the pre-strike period levels. Consolidated DSO, day sales outstanding, improved remarkably to 78 days from 122 days in the last year. This was possible due to better payment terms at UK subsidiary with premium clients at Netflix, Amazon, Sony. So at least one positive, oh my God, one positive for the UK subsidiary, one direct benefit we are seeing, the company is seeing that the cash flows again went positive and the days sales outstanding improved a lot because India's is still high because of I think the strikes, it's saying strikes, but 78 days from 120 days because of the UK subsidiary, one of us has premium clients like Netflix who are able to pay faster. And in India, in total, India and UK put together, we collected 280 crores worth of payments from clients in fiscal year 2025. Hold up. No. Yes. For UK generally, outstanding is at a level of 30 crores. That is approximately 1 month's sale. But for March 2025, we were able to receive some large payments falling due on 2nd April within March itself. Okay, so there were payments from clients that were due prox in April, but clients paid them in March themselves. All right. All right. All right. Okay. Okay. In the second half of fiscal 2025, collections stood at around 27.1 crores versus the first half of the year at 22.9 crores. So collections, money, again, they have to get money back from the film studios. Collections actually improved, increase of 80%. And in the current year, they've already received in the month of April and May 18 crores already, which is around 80% of last year's H1 first half collection. So even in India, the collections cash they're getting back from their customers, the clients, is improving. In the month of April and May of this current year, fiscal year 2026, so April and May alone, they collected 18 crores from the clients' collections, which is almost 80% of the first half. So 6 months, the first 6 months of fiscal 2025, they collected 22.9 crores, and in 2 months only, April and May of this fiscal year 2026 year in, they collected 18 crores. So collections are becoming better. Wow. All right. Again, the UK subsidiary was necessary for them actually improving the cash flow, making it over, making it over positive. Yes, making it over positive. What else can we read? The video is already 30 minutes. Okay, the EBITDA for quarter one fiscal year 2026, I believe so, is 44 crores, up by 56%. Adjusted profit after tax for the half year, because this is half year, stood at 36.3 crores, registering 105% growth. Hmm. Margin percentages at consolidated level have moderated the consolidation from international operations. Yes, I forgot to mention this. The Indian studio, the Indian standalone business, has higher margins. The UK and the French studios will have lower EBITDA and profit margins. Why? Because again, Indian studios, they have lower costs. So they will get work from of like foreign films. They will get work from foreign studios or work done outside India. They have lower costs because situated in India, so higher margins. All right. Then, as they're moving towards more offshoring work delivered from India, consolidated margins will gradually improve in fiscal year 2026. So, you see this offshoring work? So, for the company as a whole, we have the UK, we have France, and we have India. More and more done, more and more work which will be done from the India side, India studios, more offshore work, which will mean higher profit margins. So more and more offshore work, more and more work being done, handled at least by the India business. That will lead to more and more profit margins because the India business, the offshoring India business is more profitable for the company. Not the Indian studios, I guess, working for Indian film industry, but the Indian studio of Basilic Fly Studios working for foreign films, the foreign industry. That offshore work is the most profitable for the company. Yes. So I guess that's it. I think so. Yeah, I think that's it. That's it. Um, for one of us, okay, one of us profit after tax percentage is 11%. It has reached 11% profit after tax. The UK subsidiary, one of us, is 11% profit after tax, and EBITDA has reached 15% is the EBITDA we're looking at. All right. So that's it. Yeah, that's it. 33 minutes. It's more than enough yapping. Hope you have a nice day.